to the recording of the session, which we will make available to people who are not able to attend. So, bienvenue tout le monde. Je suis Pamela Isfeld, la présidente de l'APASE. And I have with me Blair Cooper and Luc Bazaillon from TradeX, which is they were here in September and gave us a really interesting talk on investing and in markets in the time of COVID. So they've agreed to come back as a follow-up to that, partly to that session, now that we're in Rrsp season and people are starting to think about their investments and so on. TradeX was founded by 5 trade commissioners and who wanted a means to invest easily, and we're having trouble navigating all of that while posted abroad. So in 1970, the fund became available to all federal employees, but there's been a long and strong relationship with PAFSO the whole time since since the organization was founded, partly because of that, for that reason. So before we start, I just would like to remind everyone to take a moment to remember the situation of our friend and colleague, Michael Kovrig, who is still in prison in China and has been for more than 2 years now. We believe it's time to bring him home, and PAFSO is campaigning along with International Crisis Group and the family of both Michael Kovrig and Michael Spavor, who fellow Canadian who is also in prison, who's not our member, but still should not be there, and we want him to come home as well. So if you have time, if you haven't already, please consider sharing our social media posters, and reminding everyone that we need to think about Michael. So before, I won't go on too long about that, and I will turn over the floor to Luc and Blair. So I'll leave it to you guys to figure out how you want to, who wants to go first?
Well, thank you very much, Pamela. I'll get us started here, and thank you and bonjour à tous. Thank you very much, PAFSO and Pamela, for inviting us again here today. This morning, and from all of us here at TradeX, we certainly wish you and all your close ones a very happy and healthy 2021. So I'll get the day started out and talking about the differences between Rrsp and Tfsa and coming up with basically a roadmap to help you decide which one's best for you, and we'll have our own we'll have our own sort of thoughts and decision as to which one that should be. And then Blair will take over the second half with a market update. Now, this is just obviously the legalese to start the day off here. Just warning everybody that TradeX is not responsible for any of the errors. Luc is responsible for any of the errors. Moving on to the Rrsp versus Tfsa section. So we'll start with just a bit of a recap here. The Rrsp and Tfsas are both financial vehicles for Canadians. The choice of one over the other really depends on everyone's individual circumstances, stage of life, your personal situation, your goals and objectives for the savings amount as well. And it's important to seek advice as well to determine which one's best for you with a professional that you have confidence in. So just to recap, the tax-free savings account now must be kind of second nature now to everybody. The Tfsa, since 2009, available to all Canadian residents aged 18 and older. You can hold a variety of investments within a Tfsa. It doesn't just need to be a savings account. It can be anywhere from one individual stock security to GICs, to savings accounts, to mutual funds. So you can hold anything you want within that tax-free vehicle. A reminder that your contribution room is cumulative, so you don't lose it if you're not using it. It does accumulate. And any amount that you withdraw can be recontributed the following calendar year. So we typically always say that if you're wanting to make a withdrawal, December is certainly the best time, because then you have the whole following year should you become should you have the amount to redeposit. So that kind of time frame has gone away. But if you're on the call in September, we can certainly say that we urge you to make your TFSA withdrawal then. And also watch out for over contributions. It is quite penal, with a 1% per month penalty on the over contribution. To date, an individual can have up to $75,500 deposited in a TFSA. So, you know, the amount has changed over the years, depending on budgets and governmental decisions, and also the amounts are linked to inflation. So you do see periodic bump up. Likely there'll be a bump up again in 2020, in 2022. We were just off by a little bit in 2021, and it's $500 increments. So likely an increase again next year. But why is the tax-free savings account beneficial? Well, just like it says in the name, we just want to show it here mathematically. If you don't have to pay tax on the investment or on the gains within the investment, you have more investment to grow over time. So in this example, we're just depicting a $10,000 initial deposit, no other deposits for 20 years. And that amount grows to just under over $59,000 here on the first column in the registered investment section. So that's essentially the TFSA. So at 9.3% every year, that $10,000 grows to $59,000. Where if you're having to pay tax on the on distributions, here we're assuming a 35% tax rate. Your $10,000 grows the same variables to $32,000, which is quite a significant, roughly $27,000 difference if you have the amount in a TFSA or in a non-registered investment account. Similarly, here we're again just depicting the difference between a non-registered account and a tax-free savings account, and this is a similar example whereby this is a $200 monthly contribution and a 5.5% rate of return. But again, regardless of amounts, timeframes, deposits, if you don't pay tax on the income or the distributions or the capital gains, you're going to be far better off than investing in a non-registered vehicle. Now moving on to the Rrsp, Registered Retirement Savings Plan. So a little bit of history. It was introduced in 1957 and for retirement for employees, and particularly the self-employed people, individuals who didn't have a pension. It was promoting the creation of a pension have one. And anyone who files an income tax return who has earned income can contribute to an Rrsp, and it's up to and including the year you turn 71. So that maximum amount is 18% of your previous year's earned income, so your previous year's salary, essentially. And then, in particular, for public servants, it's reduced by your pension adjustment for your superannuation contributions that are already being made by yourself and your employer. So your amount is certainly lower than this, but the maximum, if you didn't have a pension, would be $27,830 for last tax year. And your unused contribution room, similar to the TFSA, also does carry forward into future years. The primary advantages here are your contributions are tax deductible, so you get immediate tax relief using the dollars that you are depositing, so it reduces your income in the given year, so less tax on that end. You then shelter your deposits and your earnings into the future. So growth and earnings on your investments are not taxed as long as they stay in the plan. And then there's also the advantage of having the tax deferral. So the taxes are only paid when there are withdrawals out of the Rrsp. And typically that's in a lower tax bracket and a lower tax rate in retirement years than your working years. And we'll put a little asterisk there for public servants, but it's a little bit closer, if you will, for public servants and their pensions. But again, likely still a lower tax rate in retirement. There are numerous ways that you can withdraw or transfer Rrsp amounts. There's a few special withdrawal privileges and transfer privileges. We just wanted to highlight there is a restriction in the sense that there is withholding tax on the withdrawals in Canada. So over $15,000, it's a maximum of 30% at source, and up to $5,000, it's 10% of right at source. So that goes directly to CRA, and it's a little bit more it's a little bit higher of a withdrawal withholding tax in Quebec versus the other provinces in Canada. You can systematically withdraw from the plans, whether it's through a registered retirement income fund or an annuity, which is an insurance product. We'll get into what a RIF is shortly here. And then there's special withdrawal provisions for going back to school or buying your first home. And you always have the possibility, as well as a public servant, to transfer amounts that you have in your Rrsp to buyback pension, which in some cases is prudent to do. So those are all provisions that are embedded within using an Rrsp. So we'll go into a little detail on the Homebuyer Plan. This allows you to borrow up to $35,000 from your Rrsp tax-free, so that you don't have to pay any of that withdrawal tax at source. There's a couple caveats. You must have lived in a home or owned your home, or you must not have lived in a home or owned your home with your partner. You also have to be in a written agreement to buy or build a new home, your principal residence. And then you do have to pay back the loan that you've made to yourself, basically over 15 years. 1/15 of the amount withdrawn needs to be paid back into the plan. Now, you don't have to pay it back into the plan, but what has to happen is that 1/15 of the withdrawal gets added to your annual income over 15 years. So the tax that you save by withdrawing will get paid back in one way or another. So we certainly do recommend depositing the amount back into the Rrsp over that time frame. And the second item that we wanted to talk about here is the lifelong learning plan. Again, it allows you to withdraw an annual limit of $10,000 and up to $20,000 each time you participate. You must enroll in on a full-time basis in a qualified education for additional education. Sorry. And you can participate in the lifelong learning plan over and over again. There are no restrictions on that end, as long as your previous balance is zero or essentially paid back. So I discussed the RIF, or the Registered Retirement Income Fund. All RRSPs at age 71 need to either transfer to an annuity, or in most cases, it's a registered retirement income fund. So everything stays the same. The RRSP stays the same. The investments can stay the same. Now you're mandated to start withdrawing from the plan. and you can't make any further contributions to the RRIF, and there are obviously a wide range of investments that you can still have within the plan. There's no restrictions on what you can invest in within the plan. It's just that you now need to start taking a payment at age 72. And a little known fact is you can actually use your partner's age, your younger partner's age, as the basis of your withdrawal amount. So what that does is it if you want to keep the amount sheltered for longer, and you have a younger spouse, you can use these rates here, and it's lower for ages under 71 here. So again, it's a little known fact, but it is prudent if you're not in need of the money, and perhaps if you're wanting to stay under the zone of roughly 78 or 79, $80,000. That's one way that we recommend doing so. And the winner is the RSP with a little asterisk there. So we'll provide you with why we think that the RSP is the winner, and why your money should go to the RRSP first before using the tax-free savings account. There's a multitude of reasons why. We're going to narrow it down to about 4 or 5 here. One being the marginal tax rate in retirement. The fact that you pay lower tax now basically means more savings into the future. There's a behavioral approach that's important to recognize as well. And we'll go into all of these here shortly. There's the opportunity with the RRSP when it becomes a RIF to pension income split, similar to what you can do with your pension when you start receiving it. And this is really your best defense against OAS clawback, is pension income splitting. And then there's a discussion that we need to have about where your assets are located in the RRSP versus the TFSA, which again helps solidify why we think RRSP should be used first. So quite simply here, I'll just draw your attention. So there's 3 columns. Some of you may have seen this before. So the marginal tax rate that you have in retirement, if it's the same versus your pre-retirement years, then there's going to be no difference between $1 invested in your TFSA. So I'll just highlight at the bottom here the net cash column. So if we move to the right, a lower tax rate in retirement. Well, if you have a lower tax rate in retirement, the RRSP actually wins out just under $100,000 versus $74,000 in this example of a $36,500 one-time contribution. But this holds this holds mathematically for any deposit, any time frame. And then all to the far right column, higher tax rate in retirement. This is really the only time where the TFSA would actually win out, is if for some reason there's higher income in retirement than pre-retirement. So this could happen if perhaps you decide to go back on contract, or there's a large investment portfolio in RRSP and non-registered accounts. To give you a couple examples of how that could actually occur, but for the most part, individuals find themselves in those first 2 brackets, either the same or lower. Both cases, the RRSP wins out mathematically. Here we're just highlighting for informational purposes and in Quebec here, the 2021 new tax brackets that are out. So where you fit and where you may expect to find yourself if retirement is approaching. So lower tax now, more savings later. An RSP contribution is deductible now. So likely in your higher income earning years, you're saving a significant amount of tax on the deposit you're making. And if you reinvest that refund back into the RRSP, you can then increase your RRSP account by an additional 33% over a certain time frame with the effects of compounding that amount. So it's beneficial on two fronts. You're saving tax now, and if you deposit the amount, you have more compounding to increase your account into the future. I talked about this slightly already, the pension income splitting, where you're able to split up to 50% of your pension, your superannuation, public service pension. RIF income is similar after an RSP conversion. It can also be split. And this is by far the best way to help you keep the old age security clawback, the old age security pension that comes in at age 65. And it's important for public servants because at age 65, that's when your pension bridge benefit leaves your entitlement. So this comes to, the OAS comes to and CPP for that matter, but they both work in tandem to replace that benefit. So why not keep as much as your entitlement as possible? The RSP helps you do that. There's also this behavioral approach where, as you saw, there are restrictions on the withdrawals for an RSP, not so much on a TFSA. So I'm sure many of you are wanting to, like myself, the right corner here is a beautiful picture of the beach in Bermuda. That feels perfect right about now, but you're less likely to fund that vacation or that Tesla or those one-off purchases with an RRSP than you are a TFSA. So the TFSA is certainly more flexible and it's easier to make bad decisions, I suppose, when it comes to financial planning with the TFSA versus an RRSP where there's only a handful of reasons why and how you can withdraw from the account. And then finally, the last point I'd like to make on why we suggest the RSP versus the TFSA. Now, I should also mention, now with the largesse of the TFSA, over $75,000 can be contributed, and that over 10, 12 years, it's quite frequent that you see tax-free savings accounts well above $100,000, if not more, depending on your investments over that time frame. So it's certainly becoming a larger part of a portfolio of retirement planning. So it's increasingly important to make sure that the assets that you have are in the correct accounts and in the correct, what we like to use, locations. So if you find yourself in this situation and there's large TFSA, there's a fully funded RRSP, which for public servants is typically not as large as individuals who don't have a pension, because again, that pension adjustment amount. But we prefer to have, for these reasons, your lower growth in RRSP. If you find yourself in the situation I'm talking about here, we want your lower growth in the RRSP, so your dividend paying investments or your income producing investments, GICs, as they won't grow to an extent similar to growth stocks or growth mutual funds that typically compound at higher rates every year over time. And the reason we say that is every dollar that is redeemed out of the RSP is 100% taxed. And if it grows to a large amount and you're taxed at 100% on that RSP, then there's a little bit of implications when it comes to OAS clawback. And then conversely, in the non-registered account, only 50% of your capital gains are taxed. So yeah, you're a little bit better off on that end, the 50% versus 100%. And then your tax-free savings, 0%, no tax at any time. So back in 2009, 2010, when you could only deposit $5,000, $10,000, quite frequently you would see accounts where this was used as more of an emergency vehicle. It can still be used for that purpose, but now that they're quite large in size, it's certainly more appropriate now to have most of your growth investments growing tax-free, and try and reduce that taxation as much as possible. Now, again, this is secondary. We still believe the Rrsp is your best option, but close behind is certainly the Tfsa, and certainly if you find yourself in the enviable position where your pension is topped up, your Rrsp is topped up, and your Tfsa is topped up, well, then there's really an important consideration of making sure those assets are located in the correct plans. So with that, I think we'll move on to Blair and to Blair Cooper, CEO of TradeX, and his market update. And we'll hold any questions to the end. So Blair, please take us away, and I'll move through the slides as you go through.
Thank you, Luke, and good morning, everyone. And so on to the next slide, Luke. So 2020 was a wonderful year, as we all know, and it was quite exciting in the markets. You'll recall that back in March of 2020, we saw the end of the bull market that had started in March 9th, 2009. Primarily, the cause was twofold. So one was the Saudi Arabia and Russia oil price war, and the second was a little thing called COVID or coronavirus. At the time, we saw the US and Canadian markets drop by over 30% to the bottom on March 23rd, and it's only last week that the TSX has finally recovered back to where we were last February. Next slide, Luke. And so the Federal Reserve has recently pointed out that next slide, please, Luke. The main driver of where the US economy will go from here is going to be the evolution of the pandemic. So this slide,
sorry, we're just a little frozen here. I'm gonna see. There we go.
There we go. Wonderful. Okay. So this slide is put together by Royal Bank. I won't take any responsibility for it. And it outlines that some of the lasting implications are rather small relative to many of the other things we've seen already. So yes, permanent changes, we're going to see more public debt. We're going to see lower rates for longer. Governments and individuals are likely to be a little more concerned about viral outbreaks in the future. And hopefully we'll see more resources going to low probability, high impact risks, such as making sure that we have lots of people available at all times. There are some items that were going to happen anyway that were inevitable but accelerated. Sorry, Luke, not moving yet. And so the big move has been bricks and mortars to online, acceleration of automation, more working from home. And where this has come about in the markets, what we've seen is a huge run up in large tech companies in the US. And so those were the significant outperformers in 2020. The speed of the recovery in the US, some people have questioned, but if you think about it, back in March last year, we had a new virus that was unknown, how lethal it was, how it was transmitted, whether we would ever get any kind of a vaccine. And if you roll ahead to today, vaccines are going into arms. So there is some rationality for the impacts in the market. And again, when you look at the impacts of the government closures, the hardest hit spots are unfortunately the small mom and pop shops on our streets. And the big companies that sell online, aka Amazon, they are stealing or taking a lot of the revenues away from those. And that's why you see the huge run up that the profits on the companies that are listed on the stock exchange are actually able to grow during this item, especially the large tech names. and everything to do with the internet and working from home, such as this Zoom presentation we're doing at the moment. On top of that, the reason there was a quick rebound, and next slide, please, Luke, is in addition to the huge amount of stimulus that was done by the central banks around the globe, including the Federal Reserve's ongoing commitment to do whatever it takes, there has been significant fiscal stimulus. And so this just outlines that the initial stimulus last year from the US government, while the salaries that people were earning in the economy dropped by $1 trillion, the stimulus was $3 trillion as far as transfers to the individuals. That's why the economy didn't crater to the same extent that was expected, even though it was the biggest decline since the Great Depression. And the recent stimulus was a little bit smaller that the US put in place, but currently we've seen another gain in the markets as the quote, blue wave has now taken over. And the expectation is that bigger stimulus is coming. How did this turn out for investing in 2020? Well, the next slide shows us the asset class performance. And what's particularly interesting or unusual is if you look at the huge rebound that occurred from the March 23rd. So just to pick on one, you see that, for example, the US stocks from the bottom down 32%, according to this slide, it was up by 70% by the end of the year. Quite a significant turnaround. And so for all of you that went out, borrowed, and invested on March 23rd, 2020, congratulations. You hit the generational jackpot. Similar to those who borrowed and invested on March 9th, 2009. We go to the next slide. It just shows a little easier to see without the excess of the returns how overall things fared last year. And you can see in here that US stocks with a gain of 15.5% significantly outperformed Canadian stocks at 2.8. Historically, we believe in reversion to the mean. So that is unlikely that they will maintain that kind of excess performance versus Canadian stocks. Another interesting item that occurred during the closures of the pandemic was a huge spike in personal savings. And here it is for the Canadian savings, but basically you can see it's gone up about tenfold to over 25% of disposable income was saved during the second quarter of this year, compared to the around 2.5% of the fourth quarter of 2019. So this has been a huge impact as far as that the amount of money that is sitting ready to invest on the sidelines and the excess money that's available for individuals. Now, primarily, this impact is in those who are otherwise be out spending on travel and restaurants. And so frequently the seniors and retired that have benefited most from this huge shift and have the money waiting to spend and the pent up demand, which is part of what is feeding the market's expectations of future growth. The most significant dislocation, next slide, Luke, in the markets of all investment options is that, as you can see here, bond rates by the actions of the central banks are at 150-year lows. Now, I will take full disclosure that we expected bond rates to move up in previous periods as well. And you're likely aware that around the globe, there are a number of different locales where there are negative rates. And I think I saw an article last night that pointed out in Denmark, you can now get a mortgage at 0%. So as good as we think Canadian rates are, there are better ones out there. But nonetheless, we believe and that the likely trajectory from here, or the significantly more likely, is that rates may go up by 1% versus falling another 1%. Okay. And what's the impact of that? So this art, now I point out that the math here is a little bit dated, but it is generally still the similar type of impact. If you look at the 30-year government of Canada bond, at that time it was earning 1.6, and right now, and at the start of actually December 2019, it was earning 1.76. And it fell to a low on March 9th of 2020 of 0.7%. So the good news is this graph works both ways. If you own 30-year bonds and you sold them on March 9th, 2020, congratulations, you got this 20% gain that is showing here as a loss during the drop in the interest rates. However, if you own bonds today, and if you look at, say, an index, the duration, or which is approximately the same as these maturity dates, is 8, means that if interest rates rise by 1%, you will experience a loss of 8%. So we do not think that bonds, government bonds, offer a reasonable expectation of a positive return over the next 3 years. Even though the Federal Reserve and others have indicated they're going to keep their rates held until 2023. This is just a quick comparison between dividend yield and bond yield. So for deciding which is the best investment opportunity going forward between equity and bonds, this looks at the historic relationship. So as you can see, bond yields have tended to be above, frequently significantly above, the dividend yield on the stock market. As at December 31st, the TSX dividend yield was 3% and the 10-year Government of Canada bond was 0.7. To return to a level where the bond yield is above the TSX, this would require or would suggest that Canadian stocks basically could triple and still not be there. That's not a particular market call, but it's just pointing out the kind of excess opportunity that is apparent in stocks at the moment relative to bonds. And if we look to the US, it's a little closer. The S&P 500 dividend yield is only 1.5%. However, buybacks typically make a much larger portion of the cash return for US investments. But even at 1.5, the 10-year at the end of 2020 was 0.9%, which suggests that even at the elevated levels of the S&P 500, it still could double to just kind of a normal relationship of similar, or even the below normal relationship of matching yield on the index as well as on the 10-year. On to the next slide. Now, these are the things that make people nervous. This is looking at the price earnings ratio of the different markets around the globe. The one item I'll point out is if you look at the 10-year average, now this 10-year average, of course, is just the last 10 years. So all of this time was during the recovery out of the financial crisis. So initially, the earnings were quite crushed. And if you compare, so what looks very high over here, the trailing PE for the US at 28, as a point of reference, in January 2009, the trailing PE was over 70. And in 2002, it was over 46. Of course, each of those times it was because the economy had been and the earnings had been crushed. And we will see over the next few weeks if the US earnings are continue to outperform expectations. But the main items I would look on here is if you compare the averages, you'll note that the Canadian market 10-year average on the forward PE of 16.3 versus the US 16.8. Today, we are at a significant discount, 23.4 versus 25.8. This suggests that there is some relative value in Canadian stocks over the US. And generally consensus these days is around the emerging markets being the largest opportunity over the next while. As you can see, it's normal 10-year average at 12.2 versus 16.8 of the US, but that's now fallen. They're at 18.5 versus 25.8 for the US. Any kind of a reversion to the mean would suggest a significant improvement or opportunity in the emerging markets. As to the outlook going forward, these are the two charts on the bull and bear markets of the Canadian and US market. History may not repeat, but it normally rhymes. If we look at in the Canadian context here, you'll see the average bull market is 3.7 years. The average bear market is 8 months. And so that tends to suggest that we should have a relatively strong equity performance based on normal circumstances, as we have now recovered from the bear market of March 2020. Flipping to side to the US, you can see this, in this case, the average bull market now is at 7 years. Now that has been significantly impacted by the 2009 to 19. The average before was a little shorter than that, but nonetheless, the idea is that the outlook for equity markets based on history and based on the bear market we just came through is very strong. And on to the next slide is the reason we care. So the average investor, if you look here, over this particular decade, and it continues to repeat over various decades, that the average investor, because they choose to buy when things are high, so when everyone sees on Robinhood that Tesla stock is going to the moon, they want to buy it like crazy. And then when the markets dip, such as in March of 2020, they all sell. And they have therefore arranged to make the worst possible decisions on market timing. And the biggest pros, mostly, depending on the ego, will all indicate that no one's going to get market timing correct very frequently. And on to politics. So we're all hopeful that it'll be a much more orderly occasion on the 20th as the Biden administration takes over than what we've seen recently. But this is just outlining the expected impacts from both the Biden platform is how it's labeled, but it's now expected to have easier passage, of course, with the takeover of the Senate. So as you can see here, they do expect there'll be stricter controls, which in short term would be a negative for the US economy, but in the long term is expected to be positive. Tax increases. No one likes tax increases. Of course, there has been a quick rally when Trump and the Republicans swept in because of the cuts that they had proposed to taxes. So that's expected. That will be a long-term negative for the US equity markets. However, no one is expecting them to be worrying about tax increases in the short term, as their main focus is on fighting COVID and on stimulating the economy, which on the next one is, as I mentioned earlier, we now expect a larger fiscal stimulus package to come forward fairly quickly. And that will be a positive in the short term and a big positive in the long term as well. And this is a positive for bond yields, but a reminder, yields move opposite to price. So it means that the bonds interest rates in the US will be pushed up because of the extra borrowing and because of the strengthening economy from the fiscal stimulus. But that means that if you are investing in bonds, you will be experiencing losses. On the trade and immigration front, which you are generally in a better position than us or many of the investment managers that are breaking this out, but it's generally looked on as it will be positive for the long term, and anything that's good for the long term is good for equities. On the regulatory front, it is a long-term negative, as they do expect there will be more regulation under the Biden and Democrat platform and as opposed to what's been happening under Trump. And the other item is that with these long-term economic items, as far as stimulus, trade and immigration, etc., that will tend to benefit many of the types of companies that suffered in 2020, or at least lagged significantly in 2020. So while in 2020, the tech companies that benefited from everything being closed down and the move to work from home saw a humongous rise, as many years worth of expected growth all of a sudden came in months or days. We will now see going forward as the economy recovers, it's expected that there will be some recovery in what are called value stocks, the traditional types of things, the banks, increasing bond yields will also help the banks. We see that the dividends from stable companies like banks, again, will benefit as they will be looked on as a strong option versus holding bonds at these very low yields, and with rising rates creating capital losses. And in addition to that, we'll see things, hopefully, things like travel coming back, hotels, all of these different companies that have had the worst impact from the COVID. And so overall, it is expected to be positive. And that's what you're seeing as far as the stock market performance since the Democrats taking over or winning the elections. And on to the next slide. Again, probably those listening are in as good or better position to look at the implications for Canada from this, but generally speaking, whatever's good for the US is good for Canada. Mr. Trump brought a level of political uncertainty that we'll be happy to see the end of. We expect there'll be slightly better relations with the US, and it would be helpful to have them create more of a global leadership position than the vacuum they've had for the last period. And there also is some expectation that they may join some of the trade deals under a Biden administration going forward. The negatives, the environmental policies may limit some of our shipping of oil out of Alberta. We've had an opportunity in immigration that may be reduced. And also there is expected to be a gradual weakening of the US dollar over the next while, which may reduce Canadian competitiveness. And with that, we have about 10 minutes left in the allotted time for questions on any part of the presentation.
Thanks, Blair. That was really interesting. Folks, if you want, since there are not a huge number of you, I'm just going to allow everyone to talk, just in case you would like to ask your question rather than type it into the Q&A function. But you're certainly welcome to use the Q&A function if you wish, and the floor is open to questions. So you'll need to unmute yourselves. I've opened up the possibility, but you can unmute yourselves. I mean, Blair, I guess maybe one question I have is, I noticed that we had decided on this before January 6th, before there was, what amounts to, according to some analysts, a coup attempt or an active insurrection in the US. I mean, does that change your assessment at all? I have to admit, I haven't looked myself to see if markets have responded to those events or not.
Yeah, so generally speaking, there was a very muted response. And as much as the government, I outlined here, government stimulus has been important recently, and government actions were important during the financial crisis. In normal terms, political items tend to have very limited impact on economies over the long term. And the main item that drives stock market valuations, aside from periodic panic, is the long-term expectations and the ability of companies to adapt. And so because of that, the impact may not be near as dramatic as the CNN news headlines. And generally speaking, anything that progresses us towards Trump being out is now being looked on as good. And although it has been quite surprising for some of the various analysts, because there was thought initially that a blue wave would be looked on more negatively because of the tax implications. But at the same time, many investment managers were saying that the companies will value the removal of the wild card that is Trump and the improved expected kind of global situation for trade and commerce and all things to make much more impact than the potential tax hit. And as I said, and part of it may be short term. There may be an awakening in a year or so as the governments move away from being mainly focused on saving people to paying it off. So at that time, it may have a more negative impact on the markets if they look at expectations of sharp increases in taxes to level things off. Even in Canada, if you look at the interest rates that are available to these companies or available to the governments, the Canadian government can go out and borrow for 50 years at 1.5%. And if the central bank is able to move inflation up above 2, basically they're borrowing for free. So they don't need to be near as concerned about paying off those deficits as they've been in the past. Now, obviously, if interest rates start to move significantly and if the central banks are unable to keep controlling it with their purchase actions, then that could become more of a concern and there may be more drastic measures on deficits. But the expectation at the moment is central banks are going to keep carrying things and make sure that there are no hiccups.
Okay, thanks. That's reassuring. This is good. This is good. I mean, do you have any specific advice? I know that as public servants, I mean, working, with stable salaries and able to work from home and, with defined, benefit pensions and so on, where all of us are in a very privileged position. And, you can't help but recognize that when you look around. I see some of my neighbors who've had businesses that they've had for 20, 25, 30 years that are really just gone now. I mean, they're staying afloat kind of because of the government assistance and so on. But do you have any specific advice for us as public servants in this environment? I mean, are there specific things that we should be looking at doing or not doing, given
I guess so as you're saying, I mean, there is certainly an opportunity for people who are in the privileged position that we share as far as that have not been impacted financially to the same extent as many others. I would encourage those big savings rates, put the money to work. There has been a great deal of fear, and some of it rightly so, around COVID. And yes, it can be lethal, and it will have impacts. But hopefully, at some point, is all that's known for certain, we'll come out of it. It may be a new normal, but there will be a normal of sorts, and that over the next few years, putting aside some of that investment into a tax-free savings account, maximizing it, getting to keep all of your growth, as opposed to what Luke didn't get into too much detail. Back in 2009, when the Harper government announced the tax-free savings program, in my view, they misnamed it. So they called it a tax-free savings account because at the time they wanted to get cash into the banks. We were in the middle of a financial crisis. They wanted to support the banks. Pulling a tax-free savings account, us dutiful little Canadians ran out to the branch and we put money in a bank account. It should have been called a tax-free savings plan because, as Luke alluded to, you can invest in all the same kinds of things you can buy in your registered retirement savings plan inside of your tax-free savings account. And many people have left their tax-free savings accounts earning nominal amounts. And if you haven't looked recently, savings rate, a high interest savings account is now around 0.15% per year. And when you compare that to what's been available in the equity markets, even if equity markets, if there was no growth in earnings going forward in the future for any of these companies, and they just paid you the dividends, that's versus 0.15 is that 20 times the kind of earnings you can get. And I should point out, Luke didn't point it out, but the reason he picked that number 9.3 for the example that he did as far as your TFSA is because that just happens to coincide with the average compound return for TradeX equity fund since 1960, when the Foreign Service Officers started us. And over time, that can be a huge win. And I would just encourage people that have some extra available at the moment, put it to work. I have to admit, I don't always speak to my own cooking. I was fortunate. I did make some investments during the downturn that have been very positive impact, of course. But my wife is looking at a pool like everyone else that's looking at doing some kind of outdoor renovations at this time.
Wow.
And that too could be good as far as us supporting the local economies. And I guess I should get a plug in. The Government of Canada's Workplace Charitable Campaign is over for 2020, but TradeX does have a special program for registered education savings plans where if you do your RESP through us, we then are making a donation to the Government of Canada's Workplace Charitable Campaign, generally to the United Way. And then that is a way that you can give back to your community without taking any financial detriment during this time when so many are in need.
Right. No, thank you. That's very good to know. Thanks for that. Does anybody have any questions? Anyone want to talk, or do you have a question to put in the chat?
I should just add, Pamela, that if anyone wants to discuss their personal situation, our phone numbers are there. We are available anytime, email or phone. A group of us are actually physical in the office. Luke is working remote today, but we're always here for you. And actually, a human will answer the phone, which can be a abnormal experience these days.
Yes, always good to have that. I did have one question that came in on email, and I guess it's more related to the previous one. I think the previous presentation you guys gave, I think they didn't have a chance to ask then. They're asking if, talking about the issue of pension buybacks, the person, it sounds like, is close at the top of their pay scale, is like 3 or 4 years from retirement, from their 30 years, but has the opportunity to buy back some years of service from being a student, and is wondering if, given that the cost is pretty high, buying it back now as opposed to buying it back 20 years ago or whatever, they're asking if you have any advice on figuring out whether that's worth it.
Okay. So first off, they can contact us and we can do a specific financial forecast that'll look at the exact dollar and cents difference between buying it back and after tax, inflation, et cetera, going forward. But in general, it depends on how they are for risk tolerance and how they choose to invest. So if you are someone who owns any GICs or government bonds in your investment portfolio, then it is a slam dunk buyback. And the reason is that basically the superannuation is invested in order to deliver that 2% per year of service. It has to be invested in a mix that's going to deliver similar to the traditional pension plan has been 60% equity and 40% bonds. So you're getting a higher return, but guaranteed by the government, versus anything you're going to be able to get in GICs or bonds in anywhere else you're investing. Now, if you are someone who is willing to invest all equity, it's a closer call. And at that point, it'll depend on how much you want that certainty that comes with the defined benefit versus how much confidence you have in equities continuing to deliver, kind of a 7-8% return. But as I said, if you contact our office, we can do a specific financial forecast for you that looks at the exact impact between those different choices.
Okay. Well, and you can transfer, when you do that, you can transfer your RRSPs to do that buyback, right?
Correct. And that's normally what we recommend, because when you do a transfer of the RSP, you don't lose contribution room. When you buy back separately, there'll be a pension adjustment calculated. And in the past, on some occasions, that calculation is bigger than the dollars. So you could have saved RSP room by putting it first into an RSP and then doing the transfer.
Okay, and when you do that, do you get to top that back up what you moved, or it's just
No,
you
no, it's gone,
okay.
but you don't lose any more than the dollars you're putting in.
Oh, okay.
With the superannuation calculation, the pension adjustment, you may lose more sheltering room than the dollars you put in.
Right, right. I mean, I should not be giving anybody investment advice for sure, but my thought was just that, okay, so you take, say, $60,000 and you get then 3 more years of pension. Well, you're effectively, if your pension is more than $60,000, you've just tripled that in 3 years. Like what investment will ever give you that?
Yeah, the calculation's a little tighter than that. The calculation's a little tighter than that because when you buy back, you're just buying that 2% times whatever the buyback period is, as opposed to, yes, if you're buying the full number of years back, it can be a bigger number. But as I said, we can run through the specific calculations and including the forecast around taxes, inflation, etc. And of course, the other consideration I should have mentioned is longevity in your family.
Yeah.
Because you're healthy, and if you have a family history that suggests living a long time, then the defined benefit until you decide to shed your mortal coil is a big win. Whereas if something happens to you in the short term, or you're expecting not to last as long, and you're more concerned with how much you leave to your heirs, then leaving it in an RSP or investing on your own will win out.
Right. Fair enough. Okay, thank you. Any folks, it's 9:05 and I'm not seeing any questions. So this is kind of the last chance, the last call for questions. Anybody? Perry, I see you here. You're awfully quiet today. Not to single you out, but I know Perry, he's a frequent attendee at our breakfast and often has a question. Sounds like not.
Well, I would have asked 10 family members also joined, not just public servants.
Yes, absolutely. And it's also TradeX is available to past and present public servants and their families.
Oh, okay, that's great. That's good to know. Thanks, Perry. Sorry for singling you out there. But if no one has any questions, I will say thank you very, very much to Blair and Luke. And I hope that that you'll come back again and do the same thing periodically, as I think we're going to have an interesting period of ups and downs in the world and probably in the markets over the next little while. Next PAFSO breakfast will be, I think, on the second Tuesday of February, although I may need to move it to accommodate our next guest, who is Miriam Montreux of the Anti-Racism Secretariat at Global Affairs Canada, who's going to come and talk about her work and the mandate of her group and what they are doing to fight systemic racism and bias at Global Affairs in hiring and other HR things more specifically. So that should be a really interesting discussion. Merci beaucoup tout le monde et à la prochaine. Thanks everybody. See you again.
Thank you.
Bye bye.
Merci beaucoup.
Bye bye.